Tonight we've got the special topic is on wealth creation, and obviously we have Maddison Rogers here from Morgan's Financial. So he'll be speaking a little bit later. Towards the end of it, but I'm going to take you through a journey of wealth creation. So participation, as always, is much appreciated. If you have any questions, please speak up, put your hand up, shout out at me, whatever you need to do to get my attention, and I'm happy to take you through it. So one of the big things that I get asked about a lot at the moment is whether it's a good time to invest in property, business, and the stock market. So that's really what I'm here to talk about today, and a little bit about next week. But they're the three areas that I want everyone to be thinking about from a wealth creation perspective. I'm going to dive a little bit deeper into those ones. So as a financial disclaimer, as always, Hatcher Advisory and its subsidiaries, together with its owners, managers, and employees, have endeavored to ensure the information is accurate. You must undertake your own research and seek advice from your financial advisors, brokers, accountants, to assert its application to the specific circumstances. We don't take responsibility for any of the outcomes based on this material, keeping in mind it's all educational purposes. So 101 of wealth creation. So everyone here should be aware of the analogy of that compounding effect. So we start off, we just build block by block, we can build a house. The biggest and most important path of wealth creation is by taking a progressive approach to it. So slowly building onto it. So everyone here who's going to play the game, everyone here who's got some forms of shares, investment properties, something like that, put up your hand or comment in the comment section. Yeah. So most people, pretty much actually, I can see other people. Most people here all have some forms of some forms of investments. And we all know that we don't, we're not, when we're doing investments, we shouldn't be after that instant gratification. We should be after that long-term wealth creation. And that's what that compounding effect is. And when we're looking at that time, the horizon is really important. We've got to be careful that we're not making financial decisions and we're going to sell our house today, take $1 million cash and put it into the stock market for 6 months and then buy a new house. We can't have such a short runway. Since Maddison is here, what would you recommend is the runway that we have when we're investing in the stock market?
The longer the better, I'd say, but really it's 3 years or more, I would suggest.
Okay. So yeah, 3 years or more. So for me, when I do the stock market, I'm thinking way long. I just put my money into it and not going to look at it again for another 5-10 years. But absolutely 3 years or more, it's got to be the right horizon. Or we've got to have a different strategy, and that's some of the stuff that Maddison will talk about later, is the different strategies that we can implement if you've got a shorter time frame. But when we're talking really short stuff, less than 12 months, then it's something that you really shouldn't be doing. And likewise with property, I hear people reach out and tell me, maybe Grant, you would have people saying that they want to, renovate a house, flip it, make some quick, easy money, and they're going to make all this money by buying this property, putting 50K reno into it and selling it for 400 grand more. As you're a builder, you'd see stuff like that. Yeah. And it always comes across my desk, and I always see and hear stories like that. And then at the end of it, the question that I have is, did it happen? Did it work? Was it achieved? And when we do the tax returns, 9 times out of 10, it didn't go down the way that they originally planned. So I always think about it, time is really important. And the third one is consistency. And I think about this one a little bit differently, is saying that you have to have a strategy in place and continue to follow that strategy. So when we're talking here, it could be, like my strategy is to put money into the stock market every single 3 months. So every single 3 months, I put a certain amount of money into the stock market, say $30,000 or something like that, into the stock market every 3 months. And no matter what happens, I'm putting it in there. So if the market's up, I'm doing it. If the market's down, I'm doing it. If it's wherever it is, I'm doing it anyway. So I'll be really consistent with that strategy because I'm looking again at that long term. I don't think the market's crashed, so I'm gonna not invest in the stock market, I'm going to probably put more money in. Maddison, a quick question. Do you remember how much money I put in when the market crashed in 2020, March 2020?
Yeah, from memory, it was a fair bit more than you usually put in.
That's a lot more. So I took a punt. It was like 100 and I'm going to say 120, maybe 170 back then, when the market was down like 40, I don't know, 45% or something, almost at the bottom, but I didn't get the bottom, but I got close. And, you know, timing for that was pretty critical, but at least here being consistent. So whether the stock market's up or down, I'm consistently investing in it. And likewise with the property market, you know, I look now and go, it's an amazing time to buy an investment property. And my strategy for buying investment properties is consistent year on year. I don't have a different strategy just because the market's, you know, just because the market's good or bad. I'm going to consistently implement my strategy because I have a long-term wealth strategy. I'm going to consistently implement it regardless of what happens in the short term. And, you know, I'm quite happy if this, we're going to talk a lot about property today, but if the property market's down, you'll see me, you'll see me out there buying properties. So the best way to look at this, and, you know, some of you may have, you know, spoken to Maddison, used his services before to really understand the time value money side of things. And this is where we're looking at it and we're saying, well, in the next 5 years, in the next 10 years, how much money do I want to have? And with that, we do a calculation. So time value money for me is a way of doing a calculation. But in this context, everyone here should have a goal around how much money that they need for retire or to be financially free. So what I want you to do, oh, hi, Nick, thanks for joining. A few other people have jumped in. What I want you to do is, if you have a goal of what you want your passive income to be, then again, put up your hand or type a comment in the chat box, just to see who's got those goals around that passive income that you want to achieve from your wealth creation activities. Yep, so several people have put up their hands, a couple of people have played the game. Participation is always most appreciated. So look, what we do then, you know, we've got to work out what the desired, if you've got, Wayne, you picked a number, it's a bit hard for me, but we can do that one. If you've got a number like $500,000 worth of passive income you want to achieve, then what we've got an opportunity to do is calculate how much return would we need to achieve to generate that $500,000. And the question that you guys will have is, how do I do it really simply? How do I calculate it? So, oh, Leanne, do you have your hand up on to ask a question, or that you've already calculated yours? But the question is, how do we actually calculate it? So I do have a fun activity that I will share with you today, and also we'll be sending out. Likewise with the other activities, there still may or may not be in my inbox to send out to everyone. So I've done a lot of work around those ones. So I endeavor to get them out this week, but this one I've already completed, and I'm going to take everyone through it now. So time value money, how do we calculate how much money we want to have? So we're going to use an example. Stop presenting for a second. You just got to present a different screen, preferably one that doesn't have client data on it. So what I've got here is I've created a basic time value money calculator. And in this case here, all I'm trying to do is calculate how much money would we need to return a goal. So let's just say you earn, whether it's in the business or in your personal capacity as wages, you earn, you earn $150,000 a year. And again, you can change all these numbers because I have made it so that you can change it and you can play around with it depending on your circumstances. So you might only earn 70,000. You have to be in a positive to make this work. But say if you earn $70,000 and you have a household budget of $50,000, you would have an excess of, oh, that's great. You would have an excess of $25,000. So with that excess, the question is, what do we do with it? How much of it could we invest? So if we continue down this model, it's like, okay, well, how much money would I have to invest each year to achieve a passive income of $100,000 over a period of time? And in this case, I have it down as 20 years. You may want to change this to 10 years, which would change the number down the bottom of how much you would have to invest each year at a 9% return to achieve this. And this is why I've created a calculation for you to play with it, because everyone's going to have different requirements and everyone's going to have different opportunities, because everyone has different levels of income. So because of that, you might want to change you might want to look here and go, okay, well, I want to be financially free in 5 years. I want to make sure I want to be making, say you've got 50 grand worth of current investments and you want to have, say, $1 million worth of passive income. You'd need to be putting in 150 grand a year, because if you have $1 million worth of passive income, you're only going to be able to generate in physical cash yield around that 5%, I believe. Again, Maddison, what are you seeing from dividends these days?
Yeah, that's right. Around the 5% is probably not a bad marker, maybe plus franking credits.
Yeah, fantastic. So depending on what that passive income that you're trying to achieve, that level that you're trying to achieve, would depend on how high this number would be. But say you wanted a target of 2 million and you have a 10-year horizon, you currently have, say, 50,000, or say you have 250, say you have it in a super fund, then we'd be looking at putting $92,000 a year into some forms of investment. I'm not giving investment advice here, but I'm just saying if we did some forms of investment, we achieved a 9% return, it would need to put in 92,000 per year. So again, I'll send this spreadsheet out so everyone can have a look at it. Everyone can play with it, take your own circumstances into consideration and work through this one. But this one's all ready to go for you to play with, so it'll be out to you shortly. So that's what I was saying. So that's the time value money calculator, which is amazing for, I'll start sharing my screen again in a second, which is amazing for calculating how much money do we need to be investing per year to achieve our goals. I always do this one in front of people when I'm doing my meetings, but this way you can take it home and you can, do it with your spouse and you can play with it, and you can have conversations. I'm actually missing a 1 here, if anyone's realized. But what I wanted to talk about, so Maddison's going to talk a lot about the stock market today and different shares, but I wanted to look at the averages, and he's got some averages too over a different period of time. The NASDAQ 100 does 16%. I updated my slide deck, but I obviously opened up the wrong slide deck. But I look at the stock market and go, there's some amazing opportunities out there, even when the market's down. But the big thing that I want everyone to remember is if you're playing on overseas or international stock markets, then there's some foreign exchange that we have to worry about. So be mindful. Am I not sharing? No? Are you distracting me on purpose, Grant? Thanks, mate. Be mindful that we're going to have foreign exchange when we're investing in the overseas markets. So sometimes the results will vary. And I know for me, I've got I don't know, 300,000 or 400,000 in the US market. And when that market's up, it's really good. But sometimes the Australian dollar comes back down or increases against the USD, that eats up some of those gains. So you just got to be mindful of those foreign exchange side of things. But Maddison's going to talk a bit about the stock market, so I'm going to leave him to cover that, and that's why he's here today. So the Hatchaway property. So for me, we've got to be really mindful of, right now, interest rates are rising. Cost of living is increasing. So the way that I define an investment property is purchase for the sole purpose of making capital gains while covering its expenses, including its loan repayments. So what that means is that it's probably got a 7-8% rental yield, and it's got some form or some way of justifying a capital gain. And I know, like, looking around here, most people here have investment properties, and it's actually really hard to find the right types of investment properties that are going to achieve those type of gains. And I'm going to show you how I find them and how I look at them next. But they're out there. You just got to be patient. And there's some really cool ones. Negatively geared properties is not something that I personally jump in too much. I don't really believe in losing money to get a tax deduction, but that's me personally. But other professionals are out there and they may like them for different reasons, but for me, it's not. So a negatively geared property is one that the rental expenses exceed that of its rental income, and that would generally generate a tax refund. And a cash flow positive is one that its rental income exceeds that of its rental expenses. So for me, the hatch away property, which is different to both of those other definitions, is one that's bought for the sole purpose of making capital gains. And why that is really important is I don't want to buy a property in, I was going to use a different word then, but like regional Victoria that has got a really high rental yield, but has no opportunity for capital growth. And excluding COVID, that was regional Victoria for the last like 15 years, 20 years, excluding farms. So I don't want to buy those types of properties. But what I do want to do is I want to buy a property that's going to be able to, I'm going to be able to withstand any rate increases so that over the next 5 or 10 years, I'm going to get that capital appreciation. And that's what I'm really edging for. So with the investment properties, the two factors that I'm going for is an 8% rental yield or higher and the capital growth factor. And right now, if we think about this, if we break down what's going on in the economy right now, you've got rising interest rates that are putting pressure on the borrowing power of people. So we don't have as much borrowing power, which means we can't spend as much money on property. But does anyone here know, and in the comments, tag in the comments, but does anyone here know how many student visas have been released for this year, for 2023 year? How many people have been approved to come to Australia on student visas? This one shocked me. Pretty cool, actually. I think it's a really cool number, but it shocked me that it was so high. It's 300,000 student visas have, like students will come to Australia, 300,000 people, which is crazy. And then we have 200,000 people will migrate to Australia, which is 500,000 people will come to Australia, call Australia home, and they'll need somewhere to live. And if you think about during COVID in Melbourne and Sydney, we had all the international students that were studying at our universities down here and in Sydney. And we decided as a culture, as a government, that we weren't going to support them through COVID and we weren't going to give them any money, and they're not allowed to work with all the mandates that we had. So they all went home. Normally, we wouldn't have a 300,000 influx, but what happened then is to the apartment market, you had all those rents decreased by 20, 25% in CBD. Anyone renting an apartment in the CBD were loving it because they got a massive rent reduction. Right now, all those people have come back, and what that's resulted in is we're seeing rent increases, which is quite phenomenal. Now, these are the three different websites that I want to take everyone on today. So the first one what I want to do, and this is only applies to people in Victoria, is there is a website, and people don't know this, there is a website that you can look up zonings and titles and how big blocks of land are. And again, I'll share this out later if you want to see it. But this then gives me the ability to look at, and this is maybe I picked the wrong bit of a map, but this gives me the ability to look at, is there any opportunity anywhere here, which there doesn't look like there is, but is there any development opportunity? Then maybe here, this type of block here looks like they've probably done some type of units or something. But I'm looking at, see how there's heaps of units here? I'm looking at, is there any opportunity to do units, to buy this house, do townhouses, do a unit development, something like that. And I can even then look in and open up the report that would tell me the size of it, the zoning that it is, and if there's any restrictions or easements on the property. So this website's really cool, only applicable in Victoria. But if you're doing any type of investment properties that you're looking for in Victoria and you get stuck and you want to go, well, how do I know what area I can do townhouses or do mini developments? Then you can look at this and you can see areas around you and you can see if the neighbor's done it, it's highly likely that you can do it. And say, for example, you want to look, and we can see, sorry, you can see here that this one here, you can see that there's 3 townhouses or units being built here, which means that highly likely if I buy Centre Road, Dandenong Road, if I buy 124, I can probably do the same type of development. So 3 townhouses, driveway down the side. So that would then give me an opportunity to consider buying whatever number this one is, and I could see what the future would look like. So this website's helpful for Melbourne. Each state seems to have one. I was trying to find the one for NT the other day and I couldn't find it, but New South Wales definitely has one, Queensland has one, and I got told NT does, but I just haven't found that one yet. But there's those ones out there. So if you're looking, if you're wondering what each zoning is, you can easily find it. The data is available. You just have to know where to look. And my other one that I like to do is the property report, like a suburb report. And I'll open and share this one with you. So excluding the people that I've done this with, has anyone actually opened up a suburb report before and looked at the different suburbs in in Melbourne, in whatever your region is, whatever area you're looking into? Anyone? Hands? No hands? Okay. So if we look here, and I will pick a volunteer. Good one. Grant, what suburb you live in? Oh, maybe no, Mike. Yeah.
There you go. You hear me?
Yep.
Loftus, so 2232.
2232.
Yep. Third one down, please.
Cool. So straight away, without me doing any research whatsoever, average house price is 1.4 million. Average rent is $800 a week. Rent's gone up 16, 17%. Like I said before, 500,000 people moving to Australia right now, somewhere, moving into Australia, needing somewhere to live. Rents are going up. Interest rates are going up. Landlords are putting up rents. More people need houses. House price down. That's actually not too bad, to be honest. 2% down over the last 12 months. Average major city in Australia is down 9.1%. So this being down 1.7 is actually held pretty firm, which is pretty cool. This is the bit that will blow your mind. So 7 houses for sale in the last month, 34 sold in the last 12 months. So we want to think about that number a little bit, because again, I want people at home playing this game and looking into this themselves. If you go 34, divide that by 12. So on average, this suburb should have 2.8 houses sold per month, and 7 were available last month. So that means that double the amount of people than previous in the last month. Double the amount of people have wanted to sell because they're probably under financial pressure. And that sounds really horrible, but that you've got to double the amount of people are selling because they're under financial pressure or could be under financial pressure. But then you look at this and you go, we've got 1,155 potential buyers. Like, how crazy is that? You've got 1,155 buyers that are sitting on the sidelines thinking to themselves, I'm interested in those 7 houses, but only 7 people buy them. So what do the other 1,148 do? They're like, no, I'm just waiting. The market hasn't crashed yet. And you can see here, 33 days to sell a house in this suburb. So they're not sitting on the market for long. They're getting snapped up. So if we continue to play this game and we open up, say, a house for sale, we did pick a state that doesn't tell me prices. So thank you very much, New South Wales. Here we go, price guide, 1.6 million. So this house will sell on average in 30, that's already got under offer, 33 days this house will sell. But the question is, will it sell for market value, or will it sell below market value because someone's freaking out that interest rates are going to keep going up? And if we pick a different suburb, let's pick, who else is in here? So Prosper, what's your suburb?
I'm in Mernda, so 3754. Yeah.
I think you might be able to give me a better example. Cool. I needed a bigger suburb. So if we look at this suburb, we have 71 houses for sale in the last 30 days, 373 sold in the last 12 months. So the exact same, if you think about this statistically, again, we'd have on average, we should be having 31 houses selling per month, but we've got 71. So we've got 41 more houses selling right now in that suburb, which means, again, double amount of people than what should be, a little bit more. So 40% of more people selling the house than there should be, mathematically than there should be, which means mortgage stress, which means people thinking the market is topped, which means people are getting out of the market. Again, 31 days, right? Really quick. But out of those 71 houses that are sold, 2,292 buyers. Like, how crazy is that? That's obviously I am doing this on the fly. That's 32 potential buyers per house for sale. So what gets me excited when I look at these type of numbers, and I think to myself, what happens when interest rates stop increasing? What happens when the RBA chair, Philip, Lowe? What's it, Lowe? Anyone remember his name? He's like #1 talked about person in Australia. Yeah. So what happens when he gets sacked between now and September? Because he's going to get sacked. I absolutely guarantee that he will be resigning and will not be continuing his job past September. And his replacement is going to come in, and the first thing they're going to do is increase interest rates. But if you've got 32 people per house interested in buying, and we have one interest rate cut, and they now think that interest rates are going to continue to go down, my assumption is that they're going to start bidding on these houses. They're going to start increasing these houses. And my assumption is this house here could be, again, I don't know this house at all, but it could have a fair market value of 680,000, but the person selling it could be freaking out about interest rates. They might not be able to meet their mortgages, and maybe they take a lower amount of money. And maybe that's an opportunity that you have by negotiating with a potential seller, that you're able to get a discounted price. But I can tell you right now, when the interest rates stop going up, you will not have that ability to negotiate, because there's going to be 32 other people that will be willing to offer a price within this price range, right? That's what gets me so excited about the property market, because I'm looking at it and going, there's so many people that on the fence waiting, and whether these people are, we go back to the definition, the number of people who are seriously interested in buying listings of houses in the last month, right? So, I mean, to be serious, like, surely you have a deposit, you got your finances somewhat under control, and that gets me excited. And every single suburb, and I'll pick another one that's outside of Melbourne, but every single suburb that I've looked at, and this one was the biggest one that I've seen, and I don't know Orange, I've never been there. So has anyone ever been to Orange? Do people know Orange? Yep, that's a place, it exists, cool. Is it good? Is it nice? No. It is on record, so I won't bag it out or anything, so I don't know it. But it's up 10% in the last 12 months, which is, again, crazy, because the average is down, average major city in Melbourne down by 9%. This one has 225 houses for sale in the last month, but you consider that against the last 12 months, right? So again, last 12 months, on average, they should have 51 houses selling per month. And this is the one that I saw recently with the highest. which means that they've got 4.5, normally an average 4.5 months worth of stock getting sold right now in this suburb. So my bet is that this suburb is actually affected by interest rate increases that people have bought in and they can't afford it, and might be a lower socioeconomical suburb. And my bet is, or my gut is, that if I was to buy a house in this suburb, that maybe not that one. Do I just have my filter on too high? I was expecting lower. We're definitely expecting lower. My bet is that if I wanted to buy a house in this suburb, I'd get one for a bargain because there's so many for sale right now. It doesn't mean it's a good investment. I'm not saying that this place is a good investment because I've got no idea because I haven't done any research in it. But my gut tells me that these people are willing to sell at a discount to whatever the market is because there's so many people. There'll be so many people out there that are trying to sell their properties at once, and there's so much competition. So I reckon there would be some good deals to be had. That's why I think it's an amazing time to buy a property in Australia. Because I think that opportunity is there. There could also be an unusual high number of people exiting just because it has gone up, and maybe people are realizing that the pricing is going to stay stabilized now. So they might be just cashing in on those capital gains as well.
But would it not be worth waiting, Gary? Because let's just say, for instance, hypothetically, you said say it does raise again another 2.5 in September. I think you said maybe.
Yeah.
No, it's all hypothetical. Then wouldn't it be worth, to an extent, sitting tight and waiting? You know, what in theory, what's another cut? Well, it's not really that far away. Wouldn't it be worth them? Because this year, right now, you're saying 700. Couldn't this go down to 6?
I don't think it'll go down. It won't go down to 6 because look at this. There's too many buyers.
But are these by buyers? Is these people who are these like registered bidders?
Again, I can only go off what the definition here is, which is says seriously interested in buying. So when I go to properties at the moment, excluding the one that me and Maddison are looking at, has normally been, I'm going to show you one in a second. Actually, I'll show you one.
Okay.
Let me stop sharing for 30 seconds. This is one that I tried to buy. Oh, sorry, Wayne, I didn't read your post. Yeah, could be definitely. So this is one that I tried to buy. So this was by a tender. And the example, and the reason why I have this example is this one here. Show you some pictures. This one here is right across the road from the beach. It's in Seaford in Melbourne. Anything across the road from water, you would imagine has a great capital growth ability. It's five units. The idea that we had was to, if you have a look at them, the idea that we had was to do a small renovation because it's right next to the beach. We'd do some type of Airbnb holiday rentals, and we believed that we could get the rental yield up to that 8%. And because again, it's right near the beach, it's pretty much you can't really get closer than that unless you have a tent or something in the grass. You can't really get closer than that. So the capital appreciation would be there. So for me, it was going to tick every single box, which is why we had a real red hot crack at it. The problem with this one is if, hopefully I can show you, maybe not. The price guide for this was 2 million to 2.2 million for this property. And it was done by tender, which was a bit frustrating. So I didn't get I got to be careful. So the way a tender works is the way this one works, because sometimes I don't work this way, but the way this one worked is that we put an offer in and we can't find out what anyone else's offers are. And then at the end of the tender process, they will accept one offer. And then that's what it is. So we put an offer in at $151,000 above their asking. So I did that extra $1,000. So maybe we bet someone by 1,000 and we lost. And there was over 100 people put an offer in for this property. I'm still yet to find out. It's too soon. You can see this date. I still don't know what it sold for, but there was over 100 bids. So going back to your point there, Grant, if I say this property, it was, again, depending on the price it sells for, that it sold for, that this for me was an amazing opportunity. At $2 million, I would have like, this is owned by something to do with the police, police union, something like that. And at $2 million, it would have been a steal, like the biggest rip-off in the world. $2.2 million, I was extremely happy. We went up to, as I said, 2.35, so $151,000 above their range of their asking, and we still didn't win it. So I guess the question is, do you wait? And what happens if you wait and you miss out on some amazing properties? But also, what happens if interest rates don't result in the property market going down by, going back to this example, maybe it only goes down by another $10,000.
But how I'm viewing and understanding what you're saying, Gary, but that one there that you just showed is
just one, yeah.
Right. And you've got, and to me, this is nearly technically another business in itself, running itself. From the one orange, that to me is like pretty much, let's say, my investment down at Wollongong. I bought it 8 years ago, and to tell you the truth, I think I've been there 5 times. That's it.
How good's that though?
It's great. I don't do anything. But
that's the whole point of an investment property. I agree.
Yeah. See that other one you just showed me, mate. That would have been amazing if you could have bought that one.
I know. I mean, as I said, I tried, and I even called up the guy and I asked him 5 minutes before tender shut, what is the highest price, and I will beat it. And for whatever reason, he wouldn't tell me the answer. But going back to your point, these ones here, how low can it get? Right, because you can tell me how much does it cost to build a 3-bedroom, 1-bathroom house? This one,
Gary, from a builder's point of view, looking at this, there's a couple of things, and I can only speak from, let's say, like the Sutherland Shire, for instance.
Yep.
So there's a couple of things to first off finding out, like zoning of the property and all that, which is a really simple, easy, color-coded map, which you'll have your zoning, fire restrictions, etc., etc. But then look, me personally, from investing and buying investment properties, I think you've kind of got to go out, like, I know Orange, and I can tell you right now, there's some amazing properties in Orange, and there is some crime and some
Orange is just an example. I don't know.
People who are struggling. But like from when I looked down at Wollongong, I sort of looked at it and jumped on board and went, well, they've got mines down there.
Yep.
Infrastructure is always going to be on the boom because they've got a port. And mine's doubled in price over that 8 years.
And I would probably say, and you go back to your point though, I'd probably say that there's a reason why it's done, that region is going to do well from a capital growth perspective, and that's also important. So when we're looking at this data here, you've still got to go back to the Hatchaway definition. So they buy a property for the sole purpose of making capital gains, right? So there's still got to be an underlying reason why you believe that market's going to go well. Yeah. So this website here helps me determine whether I'm going to buy in a suburb or in a region just by some quick data. It doesn't mean, again, there's other considerations that you have to take in. Do you have to consider?
Also look at, see, one of the people who I used to, back in the day, he's retired now. He used to just hover on, for instance, the New South Wales government website and see what infrastructure projects they were even looking at bringing up, for in the future. I know the Crockers could even say this, like the South Coast, like before 9/11, the South Coast was worth peanuts, and nowadays, since everything's happened, and I can use that because I know that, for example, it's tripled in price.
Well, we can say, even in Melbourne, we can say, I publicly have always said that Point Cook is a shithole, and for the last 10 years I've said that, and I admit that, and it hasn't done much in the last 10 years. But my strong belief is in the next 10 years, Point Cook is going to go crazy from a capital growth perspective because of the infrastructure the government has been spending, and because of what's going to get finished in the next 2 years, that Point Cook now becomes an attractive suburb to me. So going back to your point, from a capital growth perspective, there has to be other underlying reasons. This is just the data that helps me make a decision. And if we go to, I haven't done Point Cook, so this could be embarrassing if it doesn't work. And this is the beauty of, looking at this type of stuff. That actually surprises me. I didn't know that. And again, it makes me bite my words of how shit Point Cook is, because I could have bought into Point Cook 10 years ago for like 300 grand. So I would have doubled my money. So, you know, it is what it is. But again, you look here and go, there's 351 houses for sale in the last month, with 1,000 being sold in a 12-month period. But this one here is taking on average, you know, 42 days, where those other suburbs we're looking at were taking 30 days, 33 days. So each suburb has a different profile of how long it's going to take to sell a house. But for me to sell a house here, if I'm a real estate agent, I've got a lot of competition, because there's 350 other houses getting sold right now, which could mean that I'm going to sell at a discount because people are going to be able to offer me a discount for it, right? And I may have other reasons why I'm forced to sell. Maybe I've just made a shit ton of money over the last, you know, what that is, that's, you know, the last 3 years, and I want to exit the property. Maybe that's what's happening. But looking at Point Cook, you've got 6,000 potential buyers for 351 houses. So, you know, that's 18 times. So there seems to be a lot of buyers out there. We'll know in 6 months' time, we'll know what the low was of the property market, but it's too late then. After everyone knows, it's done. If you remember, I think there was a moment, I reckon it was June 2020, you know, we're 3 months into COVID, and we had this like really quick dip in the property market. Some people just freaked out and sold some like fire sale stuff. And then we went boom, and it just went up heaps. And it was all this government, it's stimulus money. Everyone had access to money, and it went really quick. So again, I don't know what's going to happen, but these are the types of websites that I'm using to make decisions around investment properties, because I think having those powers or having those tools to see what's going on, that's what's going to help you in the future. Now, there is some people in here that may be able to remember this, but does anyone know what the average house price was in Melbourne in 1970? I don't think I've told anyone this one on here. No, I don't think so. So in 1970, the average house price in Melbourne was $12,800. You can fact check me on that one. And in 1990, the average house price in Melbourne was $184,000. So it went up 14x in that 20-year period. During that period, we had a massive inflationary period. We had interest rates in 1970 sitting around that 5-6%, which they currently are now. By 1990, they went up to that 17 to 19%. So we had massive inflation, massive amount of interest rates, which resulted in house prices going up bonkers. I don't know what's going to happen in the next 5-10 years. All I know is I don't want to miss the boat. And that's my point there, Grant. I'm looking for those quality properties. I don't know if I'm going to tip the market at the very bottom, but I'm doing a majority of my investment property purchasing for the next, I'm going to say 2 years, at least 2 years, is going to happen between now and July. So that's my gamble. I'll either get it right or wrong. But for me, my bet is between now and July, the bottom is. And if I find quality property that have high interest rates, so have high rental yields, then I don't mind if interest rates go up another two times, because they probably will. It's not going to make me force to sell the property, which means I'm going to hold on to them for the next 5 or 10 years. And I hope I'm talking about those properties all doubling in that period as well. How we evaluate a property. So this one I'll send out to everyone. But when we're looking at investment properties, we've got to have a way or a measure of how you can compare them, because otherwise you put emotion into it. So as an accountant, you'll all probably know that I'm sometimes a little bit brutally honest, and I try to leave some of the emotion out of it. I do the same thing with investment properties. So what I want to do is, say you've got 3 or 4 investment properties and you're seeing which one is the best one to do, which one is the best one to buy, assuming that they're all the same price, then this is the metric that I would use. I would grade each property from the building. You know, do I need to do any renovations to it, major renovations to it in the next, 5-10 years? Because that's when I'm going to sell it. What are the capital growth opportunities, again, in that next 5 or 10 year period? What is the rental yield like? And what's the overall score? So each property I'm assigning to that, I have the different metrics that I have down there. You don't need to worry about, you don't need to you don't need to worry too much about writing notes on this one, because this one I'll send out. But that's how I'm grading the different investment properties. And if you have a couple that you want me to have a conversation with, I can definitely have a conversation with you, because you know how much I enjoy talking about properties. But the main thing here is always going to be, what is your strategy? What is your long-term strategy? Whether we're doing one investment property every 2 or 3 years, one investment property every year, we're putting 10 grand into the stock market every quarter, every 6 months. We've got to have some form of strategy for investing your money, because over time, that's our most important resource. So we need to be making sure that we're doing some type of strategy for investing. And likewise in the business, in the previous webinars, we've talked a lot about the financial literacy, how much money you should invest in your business and outside of your business. But in this context, all the business owners are here. And again, I'm just having a quick look. All the business owners are here. We've got to reinvest in the business, but equally importantly, we've got to invest outside of the business. But we've got to have some type of strategy, so we're not just nilly-willy having a crack at it. So my view is, what I believe that people should be doing is somewhere between 10 to 15% of their profit or wages should be allocated to wealth creation. That means you use that money to buy shares, use that money to buy properties, or invest in your business or other businesses. But if I'm investing in another business, then I'm looking for a 30% return on my money. I don't want to be making less in the stock market. I don't want to be making less in the property market. I'm taking a lot more risk by investing in this business. So I need to be making enough returns to justify that risk. And I think a lot of people forget that part of, the returns that you're going to generate have to justify the type of investment. So again, we should be looking here at 10 to 15% of your wages, business profit, trust distribution, dividends out of the business, however you want to define that. 15 to 10% of your total money should be going into that wealth creation bucket or bag of money. So with that in mind, I can now pass over to Maddison Rogers, who's going to share to us, our special guest, who's going to share to us the stock market, a couple of special topics, and run through some of the different investment strategies that he has for us. So I can hand over to you now, Maddison.
No worries, Gary. I'll just share my screen. Right, can you see that clearly?
We can.
Yeah, perfect. So, look, I'll just introduce myself. My name's Maddison from Morgan's Financial. So I'm a stockbroker, investment advisor. So Gary's asked me to come along and provide a little bit of educational advice, really, regarding how to invest in the stock market, what are our options, what are the risk levels for people that maybe don't want to take sort of complete equity risk, and there's some options around that. And maybe what are the options for someone that really wants to put the foot down and invest pretty hard and take a bit more risk in the market. So I've listed 4 separate options to discuss today, and different ways to invest in the market. So each has their benefits, each have their disadvantages. You've probably heard of a few of them. The first being a listed investment company, the second being an exchange traded fund, or an ETF, otherwise known. Capital notes. So some people might have heard of a capital note, some people might not have.
What is a sorry, Maddison, what's an LIC, listed investment company?
Yeah, so I'll go through them with you
later. Okay.
And then just the direct investing. So I'll give you an idea of what each of the 4 are. So the first 2 types of investments on the stock market are very passive investments, or better known as sort of buy and hold and let them go type opportunities. So the first is a listed investment company, which is effectively buying an investment on the stock market that has a manager that invests in a portfolio that manages your money for them. So it's like a managed fund that's actually listed on the stock market. So effectively, it allows access to a portfolio of stocks straight away. So if you have $25,000, you can pull the trigger and you can purchase an LIC on the market, and all of a sudden you get exposure to an entire portfolio of shares. And
Sorry,
yeah.
sorry, Maddison. So if we were to say, you had $10,000 to invest, this could be the vehicle you put it in?
It could be, yeah. Look, a lot of people use these types of vehicles, these very long-term, leave the money in there for their kids. They buy them when they're 2 or 3 years old, and in 15, 20 years' time, you come back and there's a more substantial amount of money there. And that's probably an idea of where these come into play. You've got someone on your behalf managing the money. You don't have to worry about it, and you can leave it in there effectively. They do provide a really good, effective stream of income, so dividends and franking credits, and allows you to invest in that really long-term type strategy. So on what you said there, Gary, I'll give you an example of one particular company that a lot of people have heard of, Australian Foundation Investment Company. It's one of the oldest investments on the Australian stock market. They basically own a portfolio of blue chip shares. You can see on the bottom left there, I've listed their current portfolio. So they own Commonwealth Bank, BHP, CSL, Macquarie Group, and a whole lot of other companies. So with your investment that you're making, you're buying this and you get exposure to that entire portfolio. Now, as a bit of an example of what that's done over time, I've done over 20 years. You can see the price chart here since sort of 2003 up to today. Across that time, you can see the stock has grown from $3.16 per share to $7.55 over the 20 years. Now, that looks okay, and the chart's high and everything, that's fine. But something that Australian companies do that a lot of global companies don't is pay out substantial amounts of dividends and profits to shareholders. And that's where an LIC, a listed investment company, can be quite beneficial, because they'll distribute you pretty substantial income. So that's over that 20 years, that's equated to $4.55 per share, plus the franking credits that you receive or the tax credits paid. And that equals a 283% return over that 20-year period. Or if you compound it back, like Gary mentioned earlier, it's about 7% per year, every year on average. Obviously, you can see there's volatility. We have really good years and then some bad years, but over that time, if you invested for a child or yourself, it'd be about 7% per annum every year compounded. And that $10,000 that you invest would be worth just under 40 grand.
And I guess, again, going back to this one, this is a very easy decision. If we're consistently putting money into something like an LIC, it's an easy decision to be making, because we don't have to think too much, because we're getting someone's managing it and they're managing the portfolio for us.
That's right. And there's different managers out there. This is probably the most well-known business. As you can see, the size of the fund is substantial. So they own nearly $1 billion in Commonwealth Bank, $1 billion in BHP, $700 million in CSL, and it comes down. But on average, really what you're buying here is just market exposure. You're putting money in to just get general market exposure into the stock market. And that's effectively what it is. And if they can outperform, great, but largely these are very, very passive investments. The next investment you can purchase is an exchange-traded fund. And they're probably more popular than an LIC. And really what they do, very simply, is they just track an index, less a management fee that you pay to the ETF provider. So there's a whole lot of ETFs out there. There's hundreds and hundreds. You can get exposure to any market in the world. There's particular strategies that you can get exposure to. Effectively, some of the ones that are the most commonly used are the ASX 200 or the S&P 500 in the US, where effectively, if you were to put $10,000 into an ASX 200 ETF, your $10,000 would get spread across every one of those 200 companies. And whatever the market return was, so market went up, say 12% last year, your return would be 12% less a fee to the manager. So that's effectively how they work. They're just passive exposure. and looking at sort of there's different ways you can use them in your portfolio. So like I said, there's an ASX or an S&P one. You can have more of a thematic tilt to the way you use ETFs. And this is probably how I use them in my portfolios, is more around trying to get exposure to a very, very certain particular sector in the market that might be hard to get a hold of, or that maybe I don't have the expertise or people don't have the expertise in to try and pick a particular stock. So things like battery minerals, lithium, copper, really hot topic right now. There's an ETF where you can put 5 grand, 10 grand, 100 grand, whatever you like to put into it, and it'll give you exposure to a range of companies in that space. So if those companies do well over time, the ETF will do very well. Or there might be commodities. I have clients that look to just wanting to buy oil. They want to get exposure to oil for whatever reason. When it fell through COVID or now, you can just buy exposure to oil if that's what you're after. So a lot of different ways to use an ETF. 2 other strategies that I've seen them used for is, Gary, I know you're quite aware of this. We've used this in our strategy a few times, is a geared strategy. So you're actually investing in an ETF that has internal gearing that will leverage your returns over time. So, for example, today, if the market was down 1%, this particular strategy might be down 3%. Or if the market...
And I think, sorry, Maddison.
Yeah.
And I believe we've done this on, I think we did it on the NASDAQ or S&P or something. We've done some geared ETFs or LICs.
Yeah, correct. So this particular one is to the upside. So if you invest in a geared ETF, you put $10,000 in, the market goes up 10% over the year, you would expect a return of 15 to 20% in that investment. Obviously, it's geared to the market, and that's the risk you take. You take leverage risk. The other one that you're mentioning, Gary, is something which is a shorting strategy. It's called the BBUS or BBOS investments. Beta shares provide them, and if the market goes down, these particular investments actually go up. So they're inversely correlated to the market. They actually short it. And it's a way that you can get a hedge in your portfolio. I don't have heaps of clients that use them. Some more aggressive definitely do as a shorter term hedge if markets are volatile, and they can be pretty useful at that point. But yeah, like I did look at this particular one today. The US market was down 1%. This particular investment was up 4%. So it gives you that leverage effect to the upside if markets are a bit volatile. Just another way you can use an ETF in your strategy. Largely, an ETF will just track a particular index. It'll just do what that index does, less a fee. So you're effectively conceding, I suppose you're conceding defeat in a way that you're not going to outperform the market. You're just going to get that market's return. And that's what it is. People are happy to sometimes do that, to sometimes just underperform, sorry, and that's the nature of. And that's,
I mean, again, that going back to a risk perspective, again, if you've got $10,000 and you're thinking about what do I buy, I won't make fun of anyone in this group who would have put $10,000 into any type of marijuana companies, but I look at this from a risk perspective and go, if you're starting off doing some type of share investing, it could be better to put it into an ETF LIC instead of doing what I did. And Maddison, do you remember the first stock that I put $7,000 into?
Oil Search, from memory.
Yeah. And what happened?
A decade ago.
What happened the following after the purchase?
I think the oil price might have capitulated. Actually,
I think it might have. I think it might have been down like 50% within a week or so. So look, again, I look at that and go, you've got a better opportunity to make money if you're in one stock, one deliberate stock, absolutely. But when we're talking lower, if we're talking 10 grand, 20 grand, 50 grand, you might find it's better to do something like this, something like the LIC, and build up a portfolio over a period of time rather than putting all your eggs into one holding and hoping for the best, because this way it reduces your risk, right?
Yeah, absolutely. You spread across a range of different companies. You don't have that single stock risk where you buy a BHP and something happens to that particular company, or the iron ore price falls and China shuts down and it falls 10%. You don't really have that risk. You're spreading your risk a lot more, and they're a lot less volatile than a particular stock would be if you just want to take a punt on one particular company. But there's lots of different uses for them in different circumstances. Some people use them, like I said, like I probably do, for a more thematic play. Other people are happy to put $5,000 in every month for the rest of their life, and they'll do very well.
Absolutely.
In doing
It'd
that.
be a great strategy. Again, long-term, consistent, simple. But again, once we get over, I like to think once you have over 200,000, you want a more active strategy, but that's me personally.
Yeah, and I'll go through that too. Like, these are two passive, these are two strategies that you can start off with, and then we can get into a bit more sophisticated strategies later on. But I'll give you an example sort of an ETF, and just so I can explain it. I just took all this from the BetaShares website, which is an ETF provider. Gary mentioned the NASDAQ earlier in his presentation, and I've actually listed here the NASDAQ ETF. So you can go out there and put an amount of money in the NASDAQ ETF, and you basically just buy the entire index. So as you can see, the index over the last sort of 6 years or so had a stellar run. So 22%, 10, 39, 35, 35, some amazing returns in the last 5 years. And then they gave a large part of that up last year. NASDAQ capitulated last year, so it was down a third total. So you can see the index return at the bottom there in the grey line. And then you can see the ETF return. So the ETF return is always going to be a little bit lower than what the index is. So like I said, you're sort of conceding defeat a little bit, but that's okay in certain circumstances, I think.
Again, 19.
Just mute. I've done that, and that's fine.
Yeah, to give you an idea of what you're buying, if you're buying the index, the NASDAQ ETF, basically buying Apple, Microsoft, Amazon, Nvidia, Google, major tech firms. So obviously in this period of time, we've had an amazing period for those stocks. So these aren't your traditional returns. If you look back their way, they will be lower, but just this sort of period has been quite strong. And then the volatility's hit pretty hard here. Another, as far as benefit of an ETF, is if you do start to see these types of events sort of hitting the market, it's just one sell. You're not out there trying to sell 10 different stocks in free fall, like these stocks were. Amazon was, down 50% this year. You weren't trying to sell them and struggling to do so. You can just push the sell button and get that investment at that point in time and get your money back and wait if that's what you prefer. So they are quite liquid. I will compare for you an LIC and an ETF to give you an idea of maybe what's better than the other, or where you might use one versus another. So really the number of different things are, if you buy an ETF, typically it's a passive investment. Typically they don't do much. They just invest in those businesses and they track that index without too many coming in and coming out of the portfolio. An LIC, you're effectively employing a manager to be active on your behalf, to buy shares, to sell shares, and to generate a return. So quite a difference there. Something that a lot of people don't look at with ETFs from a tax perspective is every year they actually distribute the capital gains. So they fall into your investment, into your structure. So you do have to pay tax on that, depending on how well they go. Whereas an LIC doesn't do that. You buy an LIC at a certain price, and if you sell it, then you'll pay tax at your marginal tax rate, but you're not forced to pay it. So that's another, in my view, a huge benefit of an LIC over an ETF, because you can control that tax element.
And then I have different benefits for people that are watching this or will watch this on replay later. That has different benefits for people that have self-managed super funds, and whether you're in pension phase or accumulation phase. So we look at the different strategies there depending on the circumstances.
Yep, absolutely. The biggest part, in my view, and the biggest difference between these two structures where it comes into it, and it truly is, it does make an impact, is the open and closed-ended structures of these types of investments. So I'll explain that to you. So an ETF is an open-ended structure. So they have a market maker in the market at all times. There'll always be a buyer and there'll always be a seller. Now, if you go and buy an ETF and you want to put $25,000 and you click the button and you buy 25,000, you're effectively giving that provider $25,000. Now they take that money and invest it for you. That's not the case with an LIC. An LIC, effectively, it's a closed pool of money. So they have raised capital. They've got literally a company full of, say, $1 billion, and there's no more than $1 billion. They're just trading that money. So in times of volatility, if you sort of think through it, the LIC can often be much, much more effective because they're not getting people withdrawing money every day from their fund. They're not having to sell these assets every day with withdrawals coming in, having to dump these assets, which therefore in turn makes them fall again. So it's a bit of a, I suppose, it's not as effective in falling markets as an ETF structure. They actually probably are due to, and probably cause a huge amount of volatility in our markets caused from ETF. An LIC doesn't do that. You can effectively trade at a premium for what it's worth or a discount, but the close-ended structure means they don't have to sell anything if they don't want to. And largely daily reporting versus monthly reporting of the two. But that's the two different structures.
Oh, cool.
Something that a lot of people don't know about in the market is something called a capital note. This is another way to invest in the stock market. And it's a substantially lower risk way to invest than shares. You know, these types of investments, they're probably more suited to someone that likes a really good income, that likes lower volatility and more defensive exposure. We use a lot of these for retirees or to protect our portfolios in times of volatility. So I'll explain to you what they are and how they work and the characteristics of them. Effectively, they're a funding mechanism for the banks and they're listed on the stock market. So we obtain these securities at $100 per security. And in a period later on, usually 5 to 8 years, you get your $100 back. And that's effectively what it is. Now, within those years, you're paid a quarterly distribution on your money. So every 12 weeks, you'll get a fully franked dividend and paid out to you. So it's quite a good, effective way to make income and a tax-effective income. And maybe sometimes people use them as a substitute to term deposits. They're definitely higher risk than a term deposit. They're listed on the stock market. So effectively, they're a higher income option than a term deposit and then obviously than cash. So I've put here a bit of a risk-return trade-off as to what they are. Obviously, Australian shares, international shares are quite risky in the scheme of things. Property, slightly lower risk. Then comes fixed interest and these types of securities and bonds, and then comes cash. So there's somewhere between, you know, cash and obviously shares and obviously substantially lower risk than shares. Yep.
What's the rates? What are we getting at the moment for these? What type of returns?
Yeah,
just from
at
a
the
dividend
moment,
perspective.
we're getting around about 6.5% per annum. So really compelling returns on these types of investments. Now, it's not always the case. They are linked to interest rates. So as interest rates rise, the rates of return rise. Obviously, with an interest rate rise this week, this will go up.
And then what happened? Well, what happened, if you remember, what happened back in March, April 2020 when the whole stock market's down 40%?
Yeah, so that's right. So that's why we tend to use these investments in our portfolios. We use them as defensive exposure as to if there's an event in the market, say a 10%, 20%, or as Gary mentioned, a 40% fall, 38% fall in the stock market. We hope these securities will hold their value. we can sell them and we can use that money to then invest in the stock market, and which can have, phenomenal sort of impact on your returns over time. I do have an example for you, Gary. It's here, and to give you an idea of what actually happened in that event. And I'll put here, I'll start from the start. On the right-hand side, this is the date back in 2015 when a particular security was listed, a Macquarie security, and we got them at $100 per security. Now, over time, you've seen over a 7-year period or a 6-year period, effectively, this is where that particular security traded. Now, it paid about a 5.5% yield every single year. That did go up a little bit at the end with interest rates. But you can see here, this was the volatility of the security. We buy them at 100. As you can see, they went below 100 once here and below 100 once again in the major COVID crash. Between that period, they all traded above $100. Now, on the left-hand side, it probably gives you a bit more of an inclination of exactly how they traded. Remembering that when they mature, we only ever get $100 back. So hopefully you're actively managing these sort of positions, and if they ever got to $108, you might reconsider owning them.
That's like getting a whole year's worth of dividends today. If I sell at 100, if I buy at $100, sell at 108, I'm getting 8% return on something that shouldn't be giving me that much of a dividend over that 12-month period. Looking
at it like that, absolutely correct. So in the end, they do go up and down, and you try and play those cycles. Now, in the crash, this is a major market crash. Obviously, in 2020, on the onset of COVID, they were trading at 106. They went down to 96.50, I think it was. Remembering we bought them for 100. Now, the market fell 38% in that time, and you can see the capital protection that this particular security offered us in that time.
And I'll add a little bit more to that. So, Maddison, I think we had around 50 or maybe a little bit more in capital notes in my portfolio. So at some point, because again, I can't remember exact timing, but they did go down. So market's down by 38%. These are down by 5% or maybe 10%.
Yeah.
We exit them, and what do we do with the money?
Yeah, so we use these positions in an ideal scenario, Gary, like you're mentioning, in that type of volatility. They're there to protect your money and get a good return on your investment while doing that. So in the end, in an event like that, Macquarie itself, I believe it halved. It was down about 50%, down to $70 or $80. The Macquarie Capital note clearly hadn't. You'd really been able to retain your capital. We sold the note and we used that 50,000 or say 49,000 to invest in equities to do that at that point in time. Now that was a higher risk move at the time, and we talked through those types of events. But in that case is when it can work exceptionally well.
But even leading up to it, we never knew that COVID was going to happen. But and I know that it's not on your slide deck today, but prior to that period, I remember you telling me every single meeting that I had, and I have a lot of meetings because I obviously sit in meetings with clients, that we were trading, the ASX was trading at a premium, at a high PE ratio. And historically, when we do that above average, when we're trading above average, historically there's something, we'll have a pullback. There'll be something, don't know what it is, but something will happen. So what I gathered from that, and what I was getting out of those meetings, was that didn't know what was going to happen, but there's going to be a pullback in the market. And we were then able to position our portfolio in a way that reduced the downside of such an event happening. Yeah, we probably did half fluke it, I guess, but we still reduced the downside of it. Then we jump onto that opportunity when the market was, when we took our opportunities in that market.
Yeah, exactly. And that's what these are for in the end. Like, I do like them because of the income element right now is really compelling. And there was a new capital note that was announced yesterday that was a really compelling sort of yield. We're looking up towards a 6.6% plus. Some are edging over 7%. So we haven't seen that in some time, to be fair. So obviously these are half linked to interest rates, and as interest rates have risen, the yields on these investments are also going. So they've been exceptional in that regard. They're definitely not anywhere near as risky as what the shares might be. So don't expect the volatility from them. You know, if you've got cash to part cash in that you're happy to take, you know, not invest in a term deposit, maybe these can come into your strategy. I'd just be really, really stringent on price. I certainly don't, I tend not to pay anything above $101 for these, sort of ever. Remember, we only ever get $100 back when they mature. So you've got to be really stringent on your price and on your timing with them, but you can get new allocations through brokers, and that's the only way you can get them. But they are very compelling investments over time. Should you be looking for quite a low risk type option?
So I guess, like, if we were to get them on to get allocations, because I know we're doing this at the moment, I try to get allocations in we tried to get some allocations in the ANZ one and trying to get some allocations in the new Challenger one. But so, you know, getting allocation of these is sometimes a bit difficult as well, right?
Yeah, the nature of what they are at the moment is there's either a lot of term deposits rolling off at 3%, and they go, well, I've still got to pay tax on the 3.5%. And they go, well, what's left after that? You might have 3% or 2.9% sort of after tax. What's the next level up from a term deposit is probably these securities. And you're getting 6.5%, including franking credits, which means the tax has been paid. A large part of the tax has already been paid on the particular investment. So your after-tax returns are looking really good on something like this versus a term deposit, obviously versus cash. So at the moment, with a lot of cash around, people are really starting to understand that these types of investments are, I suppose, sought after and really compelling for what they are. You can sell them at any point in time. So the day that you own them, you can sell them at any point here. You don't have to wait till the maturity, which is here, right at this end. You can, and you're going to get $100 back, but in the end, you can sell them at any point in time. So they're very liquid. And that's, I think, another compelling part of them, Gary. So the demand of them has skyrocketed. Right now, you're right, we're trying to bid for a brand new security, which was announced, at a 7.2% yield. So really compelling. I think it's going to be very hard to get. So you're never going to get as much as what we want, if any. So it's quite hard, but we work through that over time. But yeah, that's what they are. They're used for a certain purpose, and not a whole lot of people often know about them in that regard. So you probably know a little bit more now. So
yep.
I'll go through then the last part, which is probably the more exciting part of investing, and it's the more transparent, flexible part of investing in shares, and it's where I focus 95% of my time on in actually going down the process of managing a direct equity portfolio and buying shares, buying a diverse portfolio, seeking higher returns in the market ideally, depending on your particular situation. And there's a whole lot of different ways you can do that in the market. I've listed a slide here as to how I do it. People do it differently. This is just how I do it. We have sort of asset allocation between our portfolios where you have cash, you have fixed interest or capital notes. Like I said, this end of the portfolio really protects you and is lower risk and is likely lower returning, but has a definite a purpose in the portfolio. Whereas the part on the left is where ideally over the very long term, you're trying to seek capital growth and income out of the portfolio. So that's high quality companies in the Australian market. So CSL, BHP, Macquarie Group, looking to buy those companies and own them over time to gain capital growth. International companies, Apple, Google, Amazon, Microsoft, brilliant businesses, and outstanding opportunities right now in the market in that space. Timing is difficult, but that will come, I believe, in coming months. And then another part of the portfolio where you can be a little bit more active and really try and seek returns over time. So this is the more sophisticated approach to investment. Remember, we have the listed investment companies, which are very, very passive. buy, hold, and don't look at them. Exchange traded funds, where very similar, but you can use them in conjunction with your other strategy. But once again, very passive, buy and hold. Capital notes, quite low risk, higher income, your retiree type product. And then you have direct investing, which is the more active, trying to put your foot down, trying to outperform the market over time and enjoy that process and have transparency with what you own. So this particular strategy should over time be a higher performing strategy. You should be seeking higher returns in it, and depending on your particular strategy, it's quite a diversified approach. So we're in there trying, sorry, Gary.
Yeah, so then like when I think about this, I always think about the different levels of risk that I'm willing to take, or someone should be willing to take. And I think and I go, okay, well, someone who's got a bit more assertiveness would be after the growth asset section, and someone who wants to be a bit more defensive, conservative would be over there, right?
Correct. That's right. And look, these parts here, it doesn't mean you have to be a conservative investor to own capital notes. Like in times where, like you mentioned, Gary, there's times where the market's just too expensive, but you still want to generate a relatively good return on your money, but the opportunities just aren't there. You don't need to be invested in sort of, higher valuation stocks at all points in the cycle, and nor should you be. And that's the idea of being active and having a management strategy across your portfolio, is that you can utilize these parts of the portfolio in times of high valuations or certain times, or in other times where Gary mentioned, the market's down by 20 or 30%, you probably don't really want to be in these investments. You want to be in the left-hand side here when there's really compelling opportunities. So it comes back to the time in the cycle, it comes back to your strategy, and it comes back to the risk you want to take. But over time, ideally, you should be sort of, I suppose, having more of a growth focus in that regard. So I put here this last slide of the presentation, a little bit of an idea around what that direct equities portfolio looks like. And now I'm talking here more the direct buying and selling and looking to generate returns from a portfolio that's ideally above the market if you can. So over time, this is a portfolio that we've managed for 12 years now. On the left-hand side, you can see the blue line, which is the portfolio, and the green line, which is the ASX 200. There'll be times in the market where you underperform and you're not going as well as the market. And there's times where that can just happen naturally with the stocks you own, and it's a risk you take. There's other times where you can be going really well above the market. But over time, as you can see on the right-hand side, over 3, 5, and sort of 12 years now, long-term, you can do things in the market that can obviously increase your returns above the market, which is what we're trying to achieve.
So with this one here, because this is one of my favorite graphs to look at. So if I put $200,000 into an index fund, ASX 200 index back in October 2011, it'd be roughly
700,000.
Yep, 700 today. And if I put it into this type of growth portfolio for that period of time, we'd be talking like $1 million.
Yeah, just over $1 million. That's right. So over a long period of time, the compounding effect sort of takes place, and that's where you can really make a substantial difference to your overall wealth. If you're on top of these issues, you can engage someone to help you to obviously manage that portfolio. But yeah, you've got to be able to ride through a little bit more volatility, I think. So to give you an idea of that, if you can have a look here at COVID. So 2020, you can see the very substantial dip in portfolio and in the market. So this particular portfolio got absolutely smacked from $800,000 back in 2020 down to $600,000. So it really got hurt during that overall sort of pullback. The portfolio actually held about 15% cash here, and it actually invested that, and we actually sold a few things on the way down and invested that money on that weakness as well. So that's a difference you have with active management versus just the market. You can make considerable choices at that point in time to benefit your situation. You then see the recovery in the two. The recovery was very, very quick in the portfolio, and it got to a point where it was above the previous high quite quickly, versus the Australian market, which took quite some time, another probably 6 months or so to do that. And therefore, this is where the outperformance comes again, is the aggressive rise in portfolio. Because you're in the market, ideally, you're taking opportunities, you're investing the cash when the time's right, versus just owning maybe an ETF or an LIC, and you can just ride through the cycle. Both outcomes are great. There's no denying that over the last sort of 10, 11 years, both outcomes are really good, and you would have done very well just being invested. That's probably the key I think Gary's trying to push home, is just be invested, invest your money over time, buy and hold a lot of it. There's just different ways to do it. And this is probably the one way that I personally prefer, and a way that you can get above the market over time and try and, if you're happy to take that risk, be able to do.
I think, each strategy. So you have Maddison, you have a minimum amount of money that you would accept to do this one here's called the growth portfolio, but you have a minimum amount of money that you'd accept to be able to even start a growth portfolio because of the different diversification that you have to do. Whereas we would have a different strategy for under 200,000 that would have over 200,000, right?
That's right. Like in an ETF or an LIC, you can invest any amount of money you like. You can invest $500 if you want. No issue. In something like this, where you're owning a portfolio of high quality companies, it's quite diversified. You've got different positions. You might own 15 stocks in that portfolio. It's very hard to split $500 over 15 stocks. So you just can't do it. So there has to be an element of size about the portfolio, and to make it worth your while too.
Yeah, no, fantastic, absolutely.
Yes.
And I mean, a lot of people here have share portfolios. Again, looking around at the names, a lot of people have share portfolios, which is fantastic. And I think, Grant, on the thing that you were touching on earlier about the properties, I think the stock market is really easy to ride the waves, because you can see how it's going from a visual perspective quite easily. And you can see here, we can all tell when the stock market's going down, because each day you're watching it go down, you're watching it fall down. And in the property market, you don't get the live data. So you don't get to find out until 60 days, 90 days, 120 days after a property sells for what price it's sold for. And then you got to collate all the information. And then it's really hard to know, because that house that sold down the road might have been renovated and yours might not be. So, or yours might be renovated and that one down the road is not being renovated. So it's really hard to get a gauge of what the actual property market is doing on a day-by-day basis. And you can only, look at over the long term. And in the stock market, we get a day-by-day reports. I used to be well and truly addicted to looking at my portfolio on a daily basis. I now don't do that. I look at it probably once every 3 months. So I couldn't even tell you if I'm up or down or whatever. I wouldn't know. I'll look at it at the end of this month, and I only ever pay attention to once every 3 months. But in that context, I do have Maddison, and I hope that he is paying attention to my portfolio, because that's what he does. And that's what, one of the services that he offers, obviously, is to manage portfolios. Yeah.
No, well said, Gary, I think. So, yeah, I think from my end, that's about it for me. I think overall, any queries, certainly be sure to click them through, or to Gary himself, and happy to discuss.
Do you want to stop sharing for me for a second? I'll just do a wrap up. So everyone, thank you very much for attending. So I will hang around to answer any questions if you have any questions for me. Next week, we do have, we're still going to be talking about wealth creation. It's going to be really exciting. It's going to be fun and enjoyable. We do have Anthony Sewell from the Property Investment Store coming on and talking about different types of property. So he will share some insights for you all there. And we do have Andrew Barnett from Trading Mastery to give us some insights again from which companies to buy, which ones not, how research works in the different types of investments. So thank you very much for tuning in. I appreciate it. I know Maddison does. It's been fun tonight, and this one did go for a little bit longer than last time, so I do apologize. And as I said, happy to hang around and answer any questions that you may have. This will be on record. And if anyone else who's watching this on record, please email in any questions that you also have.